Although there are probably 100 different ways to analyze stocks and 100 different strategies, fundamentally speaking, there's only 2 ways to make money in the stock market, either from capital appreciation, meaning the stock price goes up, or dividends. Well, what are dividends exactly? Dividends are typically cash distributions to shareholders from net income or profit. They are usually paid on a predetermined installment basis, typically on a quarterly basis, and paid on a per share basis, meaning you get more dividends the more shares of the underlying stock that you own. For example, Company A, whose stock price is at $20, pays $1 in dividends per share. If you buy 10 stocks worth $200, you will receive $10 a year. A couple more rules for dividends are: there is no obligation to continuously pay dividends, meaning a company can cut its dividend at any time. Some important terms for the investor to familiarize him or herself with are the Dividend Declaration date. This is the date that the company formally announces whether they are issuing a dividend and by how much. Second is the ex-dividend date. This is the date where the company records who is and who isn't a shareholder. And this is integral because say you want to sell a stock, sometimes it may be to your favor to sell it after the dividend X date, because then you will be technically entitled to the dividends distributed on that respective quarter. Any trading activity that happens after the ex-dividend date is not recorded and is not considered. And the third is the distribution date. This is the date when the distribution of the dividend actually occurs. Some people like to look at how much dividends you receive per share. Other people like to look at the yield, which is expressed as a percentage based on the stock price. And therefore the yield and the dividend dollars per share amount should be paired with and looked at together because it will illustrate and depict a more total picture of what's going on. Let's take 2 companies for example. Company A, their stock price is at $20 a share and they pay a $1 dividend. The $1 dividend on a per share basis has a yield of 5%, $1 divided by 20. Company B may pay $10 in dividends per share, but their stock price may be $200. This company subsequently also gives a 5% yield. You do $10 divided by $200. Assuming you pick a company that's not too risky, the dividend yield will tell you what kind of return you may expect on the stock, and therefore dividends are perceived as being long-term, more stable, and safer investments. It's important to consider that the characteristics of certain companies often determine the likelihood of that company paying dividends. For example, technology and biotech companies are notoriously known not to pay dividends. Why? Well, because you have to understand that dividends are paid out from profits or net income, and they're not an obligation but a choice by management. Well, when it comes to a biotech or technology company, you as a firm have to allocate a lot of money to R&D, which is research and development, to keep your company at its competitive edge in the marketplace. You always have to have the new technology or whatever medicine you're selling in the biotech industry. And therefore, it is not the wisest from a governance perspective to issue dividends. You're much better off allocating that to R&D for the prosperity of your corporation. On the other hand, there are some companies that don't really have much R&D on their income statement and often are flush with cash. These are utilities companies, oil and gas companies, financial companies, real estate, and often pharmaceutical as well. Stepping away from industry, often the life cycle of a company can tell you a lot about whether it will or not pay dividends. Typically when a company is just shaking out and growing, they do not pay dividends in most cases. The reason for this is because when you're a brand new company, you're very focused on growth and establishing yourself. And therefore, the profits or net income that remains on a period basis, you probably don't want to distribute to your shareholders as dividends. You want to plow back or reinvest that into your corporation so that you can experience further growth down the road. The dividend payout ratio is a metric we learn in finance, which tells you how much of the profits or net income is distributed through dividends. So for example, Corporation A makes $1 million in profit. If they decide to distribute $300,000 in dividends, the dividend payout ratio would be 30%. It's 30% of the total profit or net income. And then therefore the other $700,000, which is the 70%, can be reinvested in your corporation. We want to thank you guys for listening, and once again, happy investing.